This is the slideshow for Chapter 17, Financial Statement Analysis. Financial statement analysis is the application of ratios and metrics that allow us to make comparisons of information to better assess the financial health of the company. The financial statement analysis tools generally fall into one of three categories. You have horizontal analysis, vertical analysis, and ratio analysis. Now, horizontal analysis is the comparison of numbers year to year. This allows us to compare the performance in one period to the performance in a different period. Vertical analysis is the comparison versus a competing company or a company within the same industry, or just a comparison to industry averages in general. And then ratio analysis exploits the implications of the relationships between the numbers embedded in the financial statements. There are several internal sources from which we can gather the information that is needed to perform these different types of financial statement analysis. You can look at annual reports, MD&A, or management discussion and analysis, report of the independent auditors. This is just generally referred to as the audit opinion. You could just look at the financial statements themselves, and then of course a part of the financial statements that you could look at is the notes to the financial statements, which often contain much useful information, so those should not be ignored. For public companies, there's something called a 10-K, which is an annual report, and it must be filed with the SEC. The report is the Security and Exchange Commission. The report includes important information regarding the company's financial condition. The MD&A, or Management Discussion and Analysis, is part of the annual report, and it includes management's discussion and an explanation for the causes and various implications of those results that are included in the financial statements. Even though management is not allowed to make any statements in the MD&A that contradict what's reported in the actual financial statements or the notes to those statements, management can use the MD&A to provide context and background to help the user better understand the numbers that are reported. The audit report is pretty much a somewhat standardized statement that the financial statements were audited. Financial statements that were audited are presented according to GAAP, or generally accepted accounting principles. Having a clean audit report is pretty significant, just because if you don't have a clean or unqualified opinion, that makes the company look really bad, or makes the financial statements look really bad. But if you do have an unqualified audit opinion, even though it doesn't tell you necessarily all that much, it is a good step in the right direction for building faith with potential investors, and having potential investors have more confidence in the financial statements. The financial statements are basically where you keep all the numbers. However, the financial statements have some of the general statements that you'll see everywhere, but oftentimes the more informative pieces of information within the annual report come in the end of the financial statements, in the notes to the financial statements, because that's a lot of times where companies are forced to disclose certain issues that you may not see on the surface of their financial statements. And you can see that's basically what we just talked about. Okay, so you got a couple different options here. Match the different parts of the annual report with the description of which report we're talking about. Financial statements include the income statement, balance sheet, statement of stockholders' equity, and statement of cash flows. The financial statements, that one's pretty easy. Now, the next one attests to the fairness of the presentation of the financial statement, and that's going to be a report or report of independent registered public accounting firm, and then includes a summary of significant accounting policies and explanations of specific items on the financial statements. That's going to be our notes to the, and then is written by the company to help investors understand the results of operation and the financial condition of the company. Kind of supposed to be like the financials in more layman's terms, but this is, of course, management analysis. Now, horizontal analysis is a term that refers to the study of percentage changes in comparative financial statements. Obviously, numbers will change from year to year. However, horizontal analysis is useful in identifying unusual or troublesome trends within those changes. For instance, if most expenses increase by 10% from one year to the next, but you have one specific expense category that increases by 100%, that may indicate some type of problem, or it may indicate that there's been some type of mistake in the accounting for that particular item. In addition, horizontal analysis helps to identify changes that differ from expectations. The first, the process of performing one of these analyses is to first compute the dollar amount of the change from earlier period to the later period. So how much did whatever category you're looking at change from year one to year two. And then second, divide the dollar amount of the change by the earlier period amount known as the base period. So this will basically give you a percentage change from one year to the next given in terms of the dollars in the first year, or a percentage of those first year dollars. So now for this little example here, let's assume Smart Touch Learning has net sales in 2016 of $858,000 and $803,000 in 2015. How would you prepare the horizontal analysis for the change in sales? As you can see, first we measure the change. In this case, the change from one year to the next is $55,000, an increase in sales from 2015 to 2016. Next, we convert that to a percentage increase by dividing it by the base year sales of $803,000. Horizontal analysis indicates that sales increased by 6.8% from 2015 to 2016 in this example. This number can be compared to planned or expected sales increases, and you can analyze whether that was above or below expectations for that year. So next, let's prepare the horizontal analysis for Smart Touch Learning's income statement for the year ending December 31st, 2016. First, let's compute the dollar amount of the change for each account. I'm not going to make you go through all these one by one here, but you can see the increased amounts there. Obviously, you're just subtracting 2015 from 2016, and that gives you the amount change. And then you're just going through one by one and doing the division that we talked about before. So by dividing each dollar change by the 2015 base year amount, we can generate the percentage change for each amount on the income statement. Numbers of interest might include the observations that while sales increased by 6.8%, cost of goods sold only increased by 0.8%. We could also look at a couple of other questions. Did we experience a decline in the cost of inputs while experiencing a price increase? So is that one way that we could explain this apparent anomaly? Or did we achieve some type of new efficiencies that reduced our cost of goods sold? Why did selling expenses increase by 10.5%, but sales only increased by 6.8%? Okay, another good question. Trend analysis is a special form or type of horizontal analysis that looks at how numbers, percentages, or ratios change over time. Still basically a two-step process. First, identify a base period amount. Second, all subsequent amounts are stated as a percentage of the base period amount. So this is basically doing what we already talked about in horizontal analysis, but extending it from just, originally we talked about basically 1 year to the next, and now we're looking from, first year being the base year, any number of years into the future, and we can see the percentages that changed each year based on base year dollars. So in this example, we see that Smart Touch Learning has provided its net sales amounts for each of the past 5 years. For trend analysis purposes, we will use 2012, which is the first year presented here, as the base year. The base year trend percentage is 100% because it's just 750,000 divided by 750,000, or 1, which is 100%. Next, if we look at the trend percentage, we see that sales were only 99.7% of the 2012 sales. Then we look at 2014 through 2016. When we compute the trend percentages all the way out to 2016, we can see that the general trend is constantly increasing sales as a percent of the 2012 base year sales. In this example, prepare a horizontal analysis of revenues, cost of goods sold, and gross profit for Freedom Corporation from 2016 and 2015. We can easily set up a table for making these computations, for computing the dollar amount changes and the percentage changes. The $2,000 increase in net sales represents a 25% increase over 2015. The $1,500 increase in cost of goods sold represents a 50% increase. Together, we see that gross profit only increased by 10% over 2015. Now, vertical analysis allows us to analyze the percentage relationship of each item in the financial statement to a base amount. Usually that base amount is net sales on an income statement or total assets when you're looking at a balance sheet. Again, this process requires 2 basic steps. First, we're going to identify the base amount on the statement that will be used to determine the vertical analysis percentages. Second, we divide each amount on the financial statements by the base amount. So similar in operation to horizontal analysis. Now let's prepare the vertical analysis for Smart Touch Learning for the year ending December 31st, 2016, and for the year ending December 31st, 2015. We will use net sales as the base amount for this vertical analysis. The first vertical analysis percentage we compute is for net sales. This will always be 100%, assuming that net sales is the base we're looking at. Note that even though net sales numbers for 2015 and 2016 differ, they both are stated as 100% of the base. Because this can be applied to any financial statement for any size company, this is sometimes referred to as common size statement analysis. First, let's do the vertical analysis for Smart Touch Learning for 2015. When we divide each item on the income statement by the base year net sales amount of $803,000, each item on the income statement is converted to a percentage. These percentages, when added up all together, will add up to 100. Next, prepare the vertical analysis for Smart Touch Learning for 2016. We can see that in 2016, we achieved a better gross profit percentage at 40.2% than we did in 2015 at 36.6%. We can also compare other amounts. For example, we can see that as a percentage of net sales, selling expenses were higher at 14.7% than they were in 2015 at 14.2%. So in order to get more sales in 2016, we had to end up spending more money on selling expenses. We can also prepare a vertical analysis for the balance sheet. In most cases, we use, as was said before, total assets as the base for the vertical analysis on the balance sheet. The analysis shows that current assets as a percentage of total assets is less in 2016 at 33.3% than it was in 2015 at 36.6%. but the property, plant, and equipment net was higher in 2016 at 64.4% than it was in 2015 at 62%. When we do the vertical analysis for liabilities and equity, we will still use total assets as the base. The analysis here indicates that total liabilities as a percentage of total assets is higher in 2016 at 54.8% than it was in 2015 at 50.3%. When we apply vertical analysis to compare two different companies, because they are different sized, we call the process common size statements. There are two basic steps to the process. First, identify the two companies for comparison, and second, compute the vertical analysis percentages for each company. This example shows how two different companies can be compared once the statements are all stated as a percentage of a base amount. Often we can see significant differences in how companies choose to expend resources. For example, selling expenses for Learning School are significantly higher at 21.8% than they are for Smart Touch Learning at 14.7%. Working capital, and now we're basically going to go through some of these ratios that we look at in the chapter. Now, before I get started on all these ratios, I want you to know that these are a bunch of slides, probably 18 or 19 slides dealing with these ratios. And we're going to touch on them a little bit, but basically these financial ratios, we'll talk about, obviously you see here what the equation is to calculate the ratio. And then I'll briefly touch on what the ratio is used to calculate. Now, for any accounting majors that are going to be going on to studying for and passing the CPA, hopefully, you will see a significant amount of these on the CPA exam that you'll have to memorize. So, it may be a good idea to start trying to commit these to memory. For the purposes of this class, of course, you're never going to be asked to do anything without being able to reference your notes, your study material, your book. So it's more important for most students in the class just to see, kind of get a working knowledge of the ratios, be familiar with the terms, because in the business world you'll hear these terms a lot. Some of them are more common than others. You may have heard of some of these ratios already, but you definitely want to be able to, when looking at the ratios, see what it's telling you and understand why that's important. So working capital measures the ability to meet short-term obligations with current assets. It's computed by looking at the dollar difference between current assets and current liabilities. The current ratio measures a company's ability to pay its current liabilities with its current assets. It's computed by dividing current assets by current liabilities. Cash and cash equivalents, if they aren't already in a single account, by total current liabilities. The acid test ratio of the quick ratio measures whether a company can pay all its current liabilities if they came due immediately. It's similar to the current ratio, but is only used it only uses a limited subset of current assets. It is computed by dividing the sum of cash, short-term investments, and net current receivables by total current liabilities. Especially note here that inventory and prepaid expenses are left out of this calculation, which makes sense considering its purpose. The inventory turnover ratio measures the number of times a company sells its average level of merchandise inventory during a year. It's computed by dividing cost of goods sold by the average merchandise inventory for the year. Now, the average merchandise inventory for the year is often calculated as beginning inventory plus ending inventory, and you take that number and divide it by 2. The days sales in inventory measures the average number of days merchandise inventory is held by the company. It is computed by dividing 365 days by the inventory turnover ratio. This ratio can be particularly useful when dealing with inventory that has some type of expiration date or that will go bad at some point. The gross profit percentage measures the profitability of each net sales dollar above the cost of goods sold. It is computed by dividing gross profit by net sales revenue. Note that we've already seen this ratio when we prepared the vertical analysis that we did earlier. The accounts receivable turnover ratio is similar in purpose to the inventory turnover ratio. It measures the number of times the company collects the average receivables balance in a year. It is computed by dividing net credit sales by the average net accounts receivable for the year. Now, to get the average net accounts receivable, you use the equation beginning accounts receivable plus ending accounts receivable, take that number and divide it by 2. Now, the days sales in receivables indicates how many days it takes to collect the average level of receivables. It is computed as 365 divided by the accounts receivable turnover ratio that we just calculated. The debt ratio shows the proportion of assets financed with debt and is calculated by dividing total liabilities by total assets. The debt to equity ratio shows the proportion of total liabilities relative to total equity. It is computed as total liabilities divided by total equity. The times interest earned ratio measures the number of times earnings before interest and tax, also known as EBIT, can cover interest expense. It is computed as the sum of net income, income tax expense, and interest expense divided by interest expense. For companies with a large amount of debt, being able to cover interest is critical to avoiding bankruptcy. The profit margin ratio is similar to the gross profit percentage. It shows how much net income a business earns on every dollar of sales. It is computed as net income divided by net sales for the year. We have seen this ratio before when we looked at vertical analysis. The rate of return on total assets measures a company's success in using assets to earn a profit. It is computed as the sum of net income and interest expense divided by average total assets. Average total assets can be computed as beginning total assets plus ending total assets. Take that number, divide it by 2. The asset turnover ratio measures the amount of net sales generated for each average dollar of total assets invested. It is computed as net sales divided by average total assets. Now, the rate of return on common stockholders' equity shows the relationship between net income available to common stockholders and their average common equity invested in the company. It is computed as follows. Net income minus preferred dividends, take that number and divide it by the average common stockholders' equity. Now, the preferred dividends are deducted from net income to account for the portion of the company's income that has been pre-committed to the preferred stockholders and therefore is not available to the common stockholders. Earnings per share reports the amount of net income for each common share of the company. This ratio is required to appear on the face of the income statement and is the only ratio with such a requirement. It's computed as net income divided by preferred dividends, and take that number and divide it by the weighted average number of common shares of stock outstanding. The price earnings ratio, or PE ratio, shows the market price of $1 of earnings. This is a very popular measure used to indicate whether a company's stock is overpriced or underpriced relatively compared to its earnings. An excessively high ratio would indicate that the stock is overpriced. On the other hand, an extremely low ratio would indicate that the stock is underpriced. The ratio is computed as market price per share of common stock divided by earnings per share. The dividend yield measures the percentage of a stock's market value that is returned annually as dividends to the shareholders. It is computed as annual dividend per share divided by market price per share. And the dividend payout measures the percentage of earnings paid annually to common shareholders as cash dividends. It is computed as annual dividend per share divided by earnings per share.